Beyond every horizon lies a new frontier. Explore, build, evolve. AuraLith Frontier.
Welcome to this explainer on the equity life cycle. Look, if you're navigating today's highly competitive job market, there's a very high chance that equity compensation has become a massive chunk of your total rewards package. We're talking about restricted stock, options, purchase plans, the whole shebang. And when managed correctly, this equity is a literal wealth-building machine that can completely transform your financial future. But, and this is a critical but, without a deliberate, proactive strategy, that exact same equity can easily morph into a disastrous tax trap.
Okay, let's dive into this. Here is the fundamental problem we're looking at. You might be sitting on incredibly valuable stock certificates, paper wealth that looks absolutely fantastic when you check your account screen. But that stock often triggers a sizable, sometimes unexpected tax bill. And the real trap? You might not have the actual cash on hand to pay the IRS. Because if the value of your stock has skyrocketed, but your company is still private, you can't exactly hop onto the open market and sell shares to cover those taxes. It creates a severe liquidity crunch. So today, we're going to break down exactly how to take control of your equity so it builds your wealth rather than completely draining your cash reserves. Here is our roadmap for this explainer. First, the multi-income strategy. Second, types of equity. Third, mastering the vesting schedule. Fourth, strategic tax elections. And finally, navigating ESPPs and QSBS. We'll start with the basic mechanics and ramp all the way up to some highly advanced tax stacking strategies. Let's get to it. Section 1, the multi-income equity strategy. Okay, so adding equity to your standard base salary completely changes your financial landscape. You are no longer just managing a single, predictable paycheck. Managing multiple income streams requires a real, structured strategy, not just a generic monthly budgeting app. Without one, you're going to fall into some very predictable traps. You might overspend when those high-income vesting months hit, or you might undersave for your emergency fund because it just isn't calibrated to handle a regular income. Or, worst of all, you might completely miss setting aside the cash you're going to need to pay the taxes on those stock awards. You absolutely need a comprehensive view of all your income channels. Section 2, types of equity compensation. Let's quickly translate the endless alphabet soup you see in your offer letter. Broadly speaking, equity falls into two main buckets. First up, RSUs, or restricted stock units. This is where you receive actual shares directly, usually based on your time at the company or hitting certain performance metrics. Second, we have stock options, like your NSOs and NSOs. Now, an option doesn't hand you a share up front. It literally just gives you the right to purchase shares at a set strike price sometime in the future. The core difference here is how you interact with them. With RSUs, you automatically own the shares the second they vest. It's honestly a lot like receiving a cash bonus, just handed to you in the form of company stock. But with options, vesting just means you've earned the opportunity to act. To actually convert those options into real shares of stock, you have to actively open your wallet and spend your own money to exercise them at that predetermined strike price. Section 3, mastering the vesting schedule. And this brilliantly illustrates what we call the time versus tax friction. Vesting is the waiting game, the friction between being granted equity and actually earning the right to keep it. Here's a look at the classic 4-year schedule with a 1-year cliff. For the first 12 months, you get absolutely nothing. If you quit on day 364, you walk away with 0. But hit your 1-year work anniversary and you drop off that cliff, suddenly vesting 25% of your grant all at once. After that, the remaining 75% trickles in on a pro rata monthly basis over the next 3 years to encourage you to stick around. Once you hit month 48, boom, you are 100% fully vested. But what happens if your company gets acquired before you finish that 4-year schedule? That introduces vesting acceleration. Single trigger acceleration means your unvested shares immediately vest upon one event, the acquisition itself. Pretty great, right? However, that's actually quite rare today. The current market standard, especially for venture-backed companies, is double trigger acceleration. This requires 2 distinct events to happen. First, the company must be acquired, and second, you must experience an involuntary termination, meaning you're let go or fired without cause, usually within 9 to 18 months of that deal closing. If you get acquired and just keep your job, your normal vesting schedule just keeps rolling right along. Section 4, strategic tax elections. Now let's shift to some advanced tax mechanics. The specific IRS elections you make today are going to ripple out into massive tax consequences years down the line. Let's look at the 83B election.
This allows you to pay ordinary income tax on unvested restricted stock right up front. Why do that? Because you lock in a low valuation today, so any future explosive growth gets taxed at the much lower long-term capital gains rate. On the flip side, the newer 83I election is all about tax deferral. It allows eligible employees to delay paying taxes on RSUs or options for up to 5 years, giving you some vital breathing room to generate liquidity before the IRS comes knocking.
However, the IRS definitely doesn't make it easy. To even qualify for that 83I deferral, a company must grant similar equity to at least 80% of its US-based full-time employees in that calendar year. Because of this incredibly strict rule and the heavy reporting burdens that go with it, a lot of companies simply opt out. Always check your specific grant documents.
Section 5. Navigating ESPPs and QSBS. First, let's look at ESPPs, which allow you to buy company stock at a discount. The tax implications here completely depend on how long you hold those shares before selling them. If you hold the shares for at least 2 years from the grant date and at least 1 year from the actual purchase date, you hit what's called a qualifying disposition. Doing this minimizes the amount of your profit treated as standard wages and maximizes the amount treated as highly favorable capital gains. Sell too early, though, and it's a disqualifying disposition, triggering much higher ordinary income taxes on that spread.
Now, what's really interesting about this slide is how we can explore one of the most powerful tax exemptions in existence, QSBS, or Section 1202 of the tax code. If you join an early-stage C-Corp startup and hold your shares for 5 years, you can potentially exclude a massive amount of capital gains from federal taxes. Savvy investors use strategies like early option exercising to start that 5-year clock immediately, or they use Section 1045 rollovers to reinvest their proceeds into a new startup if they get acquired early, which keeps that vital timeline perfectly intact. And to put this into perspective, the exclusion amount is absolutely staggering. Thanks to recent legislative changes in July 2025, the QSBS exclusion now tops out at the greater of $15 million, or 10 times your adjusted basis. Before this bill, the cap was $10 million. We are talking about the very real potential for a completely tax-free $15 million exit. But it actually gets even more advanced. Because that $15 million limit applies strictly per taxpayer, wealth advisors use a highly advanced strategy called stacking. Basically, a shareholder might gift QSBS shares early on to non-grantor irrevocable trusts for their children. The IRS views each of those trusts as a completely separate taxpayer. So instead of getting one $15 million exclusion, you might be able to stack 3 of them, shielding up to $45 million from federal taxes. It requires meticulous estate planning for sure, but the savings are truly unparalleled.
Which brings us to the most important question of this explainer. Are you prepared to review your grant agreements and consult a tax planner today? Look, whether you're staring down a standard RSU cliff, debating an 83B election, or setting up a multi-million-dollar QSBS trust, the timeline is already ticking. Your equity is a profound wealth-building tool, but only if you step up and take strategic action. Don't leave millions on the table. Thank you so much for joining me on this explainer, and keep learning.
The journey doesn't end here. See you at the next frontier. AuraLith Frontier.